So historically, there have been four main challenges with modelling infrastructure risk. So firstly is looking at kind of exposure, and as it's a linear asset, identifying an address which you can actually kind of assign it to. And to do that, you need to start to split up your linear asset into multiple components and then look to assign each one of those an address. And that's what we're going to be doing with our modelling going forwards, is splitting it up into subcomponents and then assigning an address for each of those. The second challenge is really around the exposure value and allocating that across, or allocating the total value across the extent of the infrastructure. And again, it needs to be done in a clever way, because you need to take into account the valuations of the different assets along it, so the track in relation to the stations that are along it, and etc. And again, what we're looking to do is exactly that, take the total valuation and then, using an estimation technique that we've created, allocate that value across to the various assets. So that's the second one. The third piece is traditionally been around the structural performance of the infrastructure. So obviously we have vulnerability curves, and it's creating vulnerability curves for the structural performance of an infrastructure asset. And what we've done is we've divided infrastructure into 5 areas, and then underneath those 5 areas there are 13 kind of subcomponents, and then underneath that are 75 occupancy types, each with their own individual vulnerability curve. And so an example would be for transport, which is one of the overarching types. We then split that into 2, so we have roads and we have rail. And then for roads, that would split up into a number of different ones of pavements, tunnels, and things like that. So and bridges, so that's really where it goes. The fourth challenge is really around kind of estimation of the downtime that infrastructure will suffer when hit by an event. So you need to obviously take into account the downtime of individual components within the whole system, but then also take into account the overall downtime of the structure. And so in a modelling point of view, you need to be able to model the components and how they're being damaged, also model how they aggregate up into the system, but to take into account the concept of routing. So if you need to get something from point A to point B, are there multiple routes it can go down? And if so, how has each one of those been damaged in an event, and what impact does that have? So that's sort of some of the challenges we've been faced with coming up with a model for this. So traditionally, it can enhance kind of risk-based design of infrastructure. So traditionally, engineers have adopted a sort of discrete return period hazard approach to design infrastructure. So they've taken maybe 2 different return period hazards, say a 450 or a 2,500 return period hazard, and then they've used that to predefine damage criteria which they can work towards, and then that's what they're kind of designing to that damage criteria. However, using a model, what it allows you to do is have a complete range of the intensity, so across all return periods, and then you can start looking at kind of annual performance criteria. So you can look at average annual damage estimates, and instead of designing to your 1 or 2 return periods, you're then designing across a complete spectrum for how much you're happy for it to be damaged in any particular year. So that's where it starts to allow you to get to. So we see it as models really kind of allow for the market to work. And so what the model will be kind of producing are the normal model metrics. So the occurrence exceedance probability, the aggregate exceedance probability, and these then give you the average annual loss and the standard deviation. So they're metrics which the insurance industry are very used to coming out of our models. Now, that allows them to create a technical rate and then use that to price the risk. So it feeds into the pricing along with a number of other factors to really provide the coverage for the people who have got the risk, so the infrastructure providers. And then through that, obviously the insurance companies can provide insurance, but also it can go to the capital market, so through catastrophe bonds and the like. So I think catastrophe risk modelling in general can really be used to increase the resilience of our built environment, especially for infrastructure. You can start assessing different options for mitigation. So you can look at how the performance changes for different seismic strengthening techniques and really assess the difference in that so you can create the best cost benefit and have the optimum solution in the end.